welcome back once again. Let's do this as fast as we can. Today we'll be looking at valid levels and invalid level, a way of determining structure contained in a structure and telling who is in control. Yeah. I've been trying to build on this concept time and time over time again. Okay, for today, let's just look at something. We're trying to determine who is in control, and before I delve fully into what is expected, let me just lay down some simple basics. Some of us may be familiar with it. Okay, let's see. Have something like this, and we should be having something like this. And something like this. Okay. Um. And let me repeat that here. Okay. In a bullish trend, every break of structure to the upside creates a strong low. Yeah. In a bullish trend, every break of structure to the upside creates a strong low. Please take note of this, and let me put up another diagram again. In a bearish trend, for example, okay, in a bearish trend, let me place this here. In a bearish trend, every break of structure to the downside creates a strong high. So this is a high, this is a high, and this is a strong high because it was never violated by price. One. Number two, it sponsored the break of this structure. So if you want to ask yourself, where did the break of this very structure, this very low, originate from? It originated from this very high. So a strong low, strong high, strong low for the bullish trend, and strong high for the bearish trend. Now, let me put up another scenario here. We're trying to determine structure within a structure. Let's just take a look at this. Let me say we'll have a market scenario of this nature. We'll have something like this, and let's say the market did something of this nature, came this way, retraced a bit, and went up here. Let me say it retraced a bit, went this way, came back this way, and okay, sorry, and let me take this. Let me say it now went this way. Okay, sorry. So looking at this very move now, let's label here swing high, and let's call here the swing low. Okay, there's a swing high and there's a swing low, and let's look at this now. Okay, one thing you're gonna notice is most times the market may come up with a scenario of this very nature, and let me just try hit important points here. Now, if you are looking at this very point now, it will be very, should I say, deceptive for you to say this is a break of structure. Yeah. The fact the market went this low does not qualify this to be a break of structure. Why? Because it is contained within a structure high and a structure low. Yes. It is contained within a structure high and a structure low. This is a structure high, this is a swing high, and this is a swing low. So this is not a valid break that should alter the overall flow because it is contained within a structure. Now, let me put up this. Okay, and let me equally take this now. Um, okay. Now, if you're looking at this thing now, you notice that um, let me say the market just raided this low, tapped into this very block here, which is the demand zone, and from here it went up. Now, this very point here now was where this impulse was generated that took out this high. Now, this is a valid break of structure. Let me put in notes to this. Not a BOS. This is not a BOS. It's not a break of structure. And for these, we will call these valid BOS. Now, this is for a bullish scenario. And for the bearish scenario, what you have to do is to invert the structure, turn it upside down to get the reverse. Yeah. Sometimes when the market is contained within a structure high or structure low, it does a lot of things, engineer liquidity and so on. But you have to keep your eye within the overall flow. Why did we call this a valid break of structure? Because it took out this swing high here. Now, if we are looking further to buy, we should wait for a retracement into this level that gave this impulsive move that destroyed this high here. Are you getting me? We'll wait for the market to retrace into this very level that gave the impulsive move that destroyed this high here. It is only at this very point that we are interested in buying if the market should retrace down. Now, this was not a valid break of structure because maybe if you go to your chart, this might be a clean low. The market just raided it, stepped into it. Let me say this is a demand zone. For this demand zone to break this high here, it will contain some degree of imbalance. So the market was just stepping back to fill up those imbalances, rebalance price action, and go up. So, but if you've not been exposed to it, you'll be caught up within this range, thinking that this is a break of structure, and you will place an order here only for you to be taken out and your stop loss will be hit. Now, what am I trying to say? What I'm trying to say is, if you look at the structure, try to know the should I say the existing swing points where the market is being caught up between the high and the low. Anything outside this, you should be careful when trying to pull the trigger or place a limit order to make sure that you are not being engineered to become liquidity. Now, let me take off this. I said to get the opposite of this very diagram for the bearish scenario, you just have to invert the structure, turn it upside down. Now, let me remove this and let me show you another scenario that you can equally see in the market. Now, let me say we have something of this nature. Now, let me pick this. The market went this way, returned, came back again, returned. This is something of this very nature. Went up, came down here, and went this way, and okay. I have a diagram now on my screen, so let's just look at this and let me say there's a low here. Okay, looking at this now. Okay, let me put up for this very end here. Structure. We are still looking at structure within a structure. Yeah, we are looking at structure within a structure. Sometimes in the market, I keep saying it, the market is rigged in such a way that you are trading against yourself psychologically. It's a battle of psychology, emotion, thought, and so many other things. Yeah. So let's look at this now. if you look at this now, it's structure within a structure. Now, let me begin to place in labels. Let me tag these very points. These sorry. Okay, this should be it. This is a break of structure here. And okay. There's a break of structure here. There's a break of structure here likewise. And now what did I do this? Now let me just try to explain something here. The market went below this very level here, so it's a valid break of structure. The market went up, retraced, went up again. Now, some persons will start seeing this as a break of structure, but it's wrong, because this very move here, from this low here to this high, is contained between this swing high and this swing low. Now, pay attention to this swing high and this very swing low. This is not a break of structure. This move down, this move up is not a break of structure. Remove your eye from what happened here. It's not a break of structure because it is contained between this swing high and this swing low. Now, let me mark out zones now. If you pull out this now, you notice something. What did you notice here? This is a supply level. So what did the market do? The market just went up, tapped into the supply level. Maybe as a supply level that broke structure here, there should be some degree of imbalance contained here. So the market was trying to balance or make the market that was left inefficient efficient. So the market stepped into this very level, and from here it's dragged down. But if you are not actually inclined to the overall structure, putting your eye on the overall order flow, you might take this to be a break of structure, but it is not true. Now, what did the market do? After getting tagged at this very level, it simply went down. Now, when this market broke this swing low here, our structural reference point shifts. It shifts to this very low here, 1. It shifts to this very high here. Why? This is the very high that was responsible for breaking this low. So this should be marked out and this should be marked out. So between these two very points now, we have our swing high and our swing low. This is now the new structural reference point for the existing order flow in the market. Now, at what point are we going to consider this market to be bullish? We'll consider this market to be bullish if price action closes above this high. Above this high that sponsored, remember, this very high now sponsored the break of this low. This high sponsored the break of this low. This high sponsored the break of this low. Now, there is a change of order in price delivery if price action closes above this high that sponsored the break of this low. Now, we'll still get further down into liquidity runs and some scenarios in liquidity runs. So just look at this now and try to just be calm. Look at what I just showed you. Be calm and look at what I just showed you. Now, from this very point now, if price action happen to run and close above this high, the market is bullish. The market is now bullish. What do we have to do now? Look at the new structural points here. It's going to be this high and this low. Why this low? This low sponsored the break of this high. And why this high? This is the level where the market closed at. Or the recent high created, the swing high created by price action. Now, if we want to enter this trade, we'll have to wait for price action to step into this level that sponsored the break. Now, a very important cheat for you. If you notice where the market broke structure or created a change of character, that's a change in order flow, there must be a strong displacement that sponsored that move, and that displacement will come in the place of an imbalance. So what do you have to do? You have to move down to look for where the displacement started. It will be the genesis of the impulsive move. So if you want to look for the genesis of the impulsive move, it should be here. This is the genesis of the impulsive move that took out this level, and there will be some imbalance here. The market will only come down to rebalance price action, make the inefficient market efficient, and continue this move up. So if we want to buy, we should be risking, let me say, from here to here, and we should be targeting few pips above this high. A nice risk to reward. This is how the market goes. Anything other than this is not calculated. Price action in itself is calculated, but it makes, since it involves money and emotion and psychology and some other factors, underlying factors, it makes you feel you against yourself. It brings kind of rig. It's a kind of rigs your psychology and thinking. So at this very point, I will be calling today. I will come up with some other videos to help simplify other facts. Watch out for it. I'll get them uploaded as soon as possible. Thank you.